Meta just did something important. After years of spending tens of billions on AI with mixed results, it finally launched a model that can compete with the best. The question is simple. Does this actually change the business? Or is it just another expensive experiment? Meta's core business is still extremely strong. The company generated around $60 billion in quarterly revenue recently, with ad impressions up 18% and pricing up about 10%, driven largely by better targeting and engagement. This matters because Meta only has two real levers: show more ads or make each ad more valuable. And right now, it's doing both. At the same time, costs are exploding. Meta is guiding to roughly $125 billion in capex and $162 billion in operating expenses for 2026. This changes the story because the business is no longer just a high-margin ad machine. It's now a capital-intensive AI infrastructure company. You're trading efficiency for future capability. The stock trades around $575, while the estimated fair value is $850, which implies it's trading at about 0.68 times fair value. That's a 30% plus discount. This matters because the market is clearly pricing in skepticism around those AI investments. On multiples, Meta is around 24 to 25 times earnings today, with forward PE expected to compress toward approximately 20 times as earnings grow. That's not cheap in isolation, but for a company expected to grow revenue approximately 18% annually, with approximately 40% operating margins, it's reasonable. The key question is whether margins hold as AI spending continues. The key shift is that AI is finally becoming operational, not just experimental. The new Muse model is competitive with top-tier models like Claude and Gemini. This matters because Meta doesn't need to win AI broadly. It just needs AI that improves ads. And that's exactly where the impact shows up. Better models improve targeting, increase time spent, and raise ad conversion rates. Even small improvements, like a 1% increase in conversions, translate into billions at Meta's scale. This changes the story because AI is no longer a cost center. It's starting to feed directly into revenue. Meta's real competition isn't just other social platforms, it's AI labs and ad ecosystems. Alphabet is strong on both fronts, while companies like Snap and Pinterest compete on attention but not infrastructure. This matters because Meta's advantage is scale, nearly 4 billion users, and data which directly improves its ad engine. The biggest issue is capital allocation. Reality Labs is still losing over $16 billion annually, and AI spending is ramping aggressively. This matters because even a great core business can be diluted by poor investment decisions. There's also regulatory risk. A potential antitrust case could force a breakup, which would weaken Meta's network effects. And finally, there's execution risk. AI only works if it actually improves monetization fast enough to justify the cost. If AI continues to improve ad targeting and engagement, Meta can increase revenue per user globally, especially in under-monetized regions like Asia and Africa. This matters because the user base is already massive. The upside comes from monetization, not growth. At the same time, new ad surfaces like WhatsApp and Threads are just starting to scale. If those monetize successfully, you get both volume and pricing expansion at the same time. Meta is no longer just a social media company. It's becoming an AI-driven advertising infrastructure business. The core engine is extremely strong, and AI is starting to enhance it in measurable ways. The stock looks undervalued, but only if AI spending actually translates into sustained margin strength and revenue growth. That's the bet. I'll break down the next one soon. Subscribe if you want to stay ahead.